August 12th, 2024. Today was a triangle day. I feel like it's been a little while since we've seen a really true triangle day. And when you get these triangle days, it's really important to be extremely patient. You can see, early on in the day, so if you just go to right here, you can see it looks like the triangle is this. And this is your breakout. So you're thinking, okay, well, bar 42 is the breakout. And then, but why is 43 bad follow through? When you see, if you're taking the sell 43, or sorry, 42, and you see 43, you have to exit your trade. And the broader point I'm going to be making with this is it's the same concept with buying above 46. On days like this, if you're going to take these sorts of stop entries, now you can see you think, okay, well maybe the triangle is this. The triangle, obviously, on the lower side, it morphed a lot today. So at one point it was this, it was this. At one point it was this, and then it became that. And if you're going to take trades like selling below 42 and then you get bad follow through, you can't be hopeful and stay in the trade. You just have to get out at the market, basically for break even. Same thing. If you buy above 45 and you see 46, that's not good follow through. You have to get out at the market. If you sell 51 and you see 52 and you see 53, really not great follow through. So you're probably going to want to just get out. And that's what causes these quick reversals back up and these quick reversals back down is traders taking a quick chance. And when it doesn't do what they want it to do, they're just really quick to exit. Yesterday finished and we ended up with basically an expanding triangle coming into the day. And then we got an actual triangle. You could draw it like this, you could draw it like this, you could draw it like that, however you want to draw it. But the point is, there was no real breakout today. And when you get this is a breakout mode pattern. Since it was over the course of over a day, some traders would call it a diamond pattern, but I don't know. I just look at it as a expanding triangle and then a normal triangle. We got the same sort of situation over here last Thursday. You can see we had an expanding triangle and then a triangle. Same sort of situation. So what does this mean? It just means there's going to be a breakout. I don't know when. And again, it's not worth your time or your money to, if you took these kinds of trades and you lost money, you should probably just be better off waiting for follow through because it's going to be really difficult it's really difficult to keep taking these trades and keep getting out of them really quickly. And it's really hard to not get hopeful that the market's going to break out. So I did sell 42 and then I got out pretty quickly and I decided I wasn't going to keep doing that kind of trading because I thought that, I'll just wait for the breakout. I'll wait for a breakout with follow through and then I'll trade that. And that's going to take a lot less energy. I'll make a lot less mistakes if I just do that. And I just didn't take any other trades for the rest of the day because there's nothing really to do in here. So really important on these sort of triangle days to be very patient and wait for a breakout. And if you don't get the breakout, that's okay. There's always tomorrow. We're pretty clearly making our way towards the apex of the triangle. You can see we broke above the bear channel line here. So we're pretty clearly making our way to the apex. And generally, when you've been in a trading range for this long and you reach the apex of the triangle, there's a 50-50 chance of a breakout to the upside or a breakout to the downside. So it's very possible we get a reasonably good gap tomorrow in either direction. And if we do get a reasonably good gap, you have to keep in mind that the first breakout of a triangle, 50-50 chance it fails. So even if we get a big gap up, it's probably not as bullish as it appears, and you have to be aware of a bull trap. And even if we get a big gap down, it's probably not as bearish as it appears, and you probably have to be aware of a possible bear trap. So I think those are things to keep in mind for tomorrow. Again, I don't know if there's going to be a gap, if there is, or what it's going to look like, but I would be a bit surprised if we opened in this area tomorrow, because in my experience, I remember a couple of days in the past where I would try to trade the breakout all day and I would just lose money all day. And then the breakout would happen, but it happened in the Globex session, and there'd be a big gap up, and I'd be really frustrated the next day because I lost a bunch of money trying to trade a breakout that didn't end up happening until after trading hours. So again, I think on this, once you start to do this, I think it just makes more sense. Once you see it's a triangle, you should probably just start sitting out and wait for the breakout and wait to see if it has follow through. Because again, whenever these get bad follow through, you just got to exit the trade. So all right, I believe that was all those points I wanted to cover. So we got a small gap up on the day. And so this is the open of the week, probably going to be a magnet later in the week. It's a double top for the bears with, let me turn the study on. There we go. Oops. It's double top for the bears with yesterday's bar 49 or 50. What do the bears want? Well, they want, basically what they got, a really good looking couple of bear bars in a breakout below the neckline. The neckline is the lowest price between the two pieces of the double top, which in this case would be the bar 62 low. So the bar 62 low is the neckline of the double bottom, or sorry, of the double top. Some traders will, and the reason it's important is because whenever you get some sort of double top, there's a 40% chance that you're going to get a breakout below and a measured move down. And you can see here, we've got below the neckline of the double top, but that's where we ended up reversing. Bar two, the big bear bar closing near its low. When you got the close of bar one, I thought we were probably going to get back into yesterday's tight trading range because you don't usually break out from a tight, or sorry, I'm stumbling over my words a little bit today. It's been a long day. You don't usually get a strong breakout of a tight trading range. And so you can bet against breakouts succeeding. So I thought there was a reasonable enough chance that the breakout above the tight trading range here was going to fail. Generally, when you do get the breakout above a tight trading range and it fails, you can expect the market to try to test the other side of the tight trading range, which we did. So you get a failed breakout above a trading range, you can generally expect a test of the low of the range. Bar two, a big bear bar, closing relatively near its low, a big tail on the top. It's definitely a bear surprise. It's reasonable to take the short below two, taking a chance we've seen the high of the day. The bulls who bought below one are obviously very disappointed in two. However, bar one was still your signal bar. I think two is big enough that that doesn't matter as much, but it is important to note that bar one was still your signal bar. You can see a lot of the quote unquote trends we had today. Bar six was the signal bar for this bull move. That's not very good. Bar 21 ended up being the signal bar for this bear move. So you can see a lot of the signal bars for the trends, the potential trends today, were not all that strong, which was another hint that today was going to be a trading range day. Bar three, another big bear bar closing near its low. So bars two and three, consecutive bear bars, large and closing near their lows. Whenever you get consecutive bear bars, any sort of strong bear move on the open, you have to keep in mind there's a 50-50 chance it's just a vacuum test of some sort of support or resistance. It's reasonable to sell below three, but this was an area of support yesterday. So you have to keep in mind, and you have to keep that in mind and watch how the market behaves around the neckline of the double top. Four, another bear bar, but a tail on the top and a tail on the bottom. Yes, it's still sell to close, sell for any reason. We're clearly always in short. I think we were always in short on the close of two. So I think this flipped the always into short. So it was reasonable to take the sell below two. And you can see bar four, still sell to close, but tail on the top and tail on the bottom. Bar five, a bull bar, but a tail on the top. It's a bad low one short for the bears. So the bears, they're selling a low one short towards the bottom of a trading range. So the bulls think that this is going to end up being a trading range open. The bears are hoping we collapse below bar five and we start some sort of large bear trend. Maybe we just get back down to this low and form a larger trading range. But instead, we never ended up getting there. Bar six, a bear bar, but a big tail on the top and a tail on the bottom. So not quite as good as it could be. We're probably going to pull back for a couple of legs sideways to up. How much higher are we going? I don't know. I mean, this was unlikely. This was clearly a surprise on 8. So it wasn't likely that we were going to bounce this high this quickly. After you see 2, 3, and 4, odds are you're going to get some sort of lower high. And so the trader is taking the short, hoping to get some sort of lower high. They see bar 8 and they think, oh, now I might be trapped in this trade. I wasn't, the bulls, they were okay if the bulls got a couple legs sideways to up. There's going to be some profit taking whenever you get that big of a move. But ultimately, they were expecting a second leg sideways to down from 2, 3, and 4, even if we pulled back. However, bar 8 changed the whole day. Bar 8 wasn't supposed to happen. It's a surprise bar. So that's why when we got bar 8, odds favored a new high of the day and stops of those bears being run. Really interesting thing happened. I'm just going to show the extended hours for a second because we broke above the Globex high and below the Globex low today. So I'm just going to highlight these real quick and then get back to the review. But there was something I wanted to mention with that, but not till like bar 15 or 16 or something. So for now, just ignore those lines. Bar 7, a bull bar, but a tail on the top and a tail on the bottom, and it triggered above 6. Had bar 7 been an inside bar, it would have been better for the bulls because you can bet on a possible bear trap, failed breakout below the low 1, and 7 would have been your signal bar, being a good-looking bull inside bar. However, bar 6 is now your signal bar, and it's a bear bar, so really not as good as it could be for the bulls here. Then, as I mentioned, we get a surprise up on bar 8. Really, really large bull bar closing on its high. It's the biggest, best looking bar that we've had so far today, and it's a massive reversal basically. So it's by the close bar 8. What's the problem with buying the close of bar 8? Well, you have to put a stop below bar 6. So a lot of traders, they see 2, 3, and 4, and then they see 8, and they're hoping to buy, but they also know that 2, 3, and 4 were reasonably strong, so we might pull back a little bit first. So a lot of traders are hoping that we're going to get a pullback and they can buy maybe a 50% pullback or some sort of correction or a reversal up from a correction of bar 8. However, a lot of times when everyone seems to want to buy a pullback of bar 8, a lot of traders will establish a small position towards the top in case we do this, and they'll look to buy more lower. But when too many traders do that, you end up never getting the pullback, and that's kind of what happened today. We never got the pullback that the bears were hoping for. 9. Sorry, 1 second. 9 consecutive bull bars closing near their highs, 8, 9. I think, it's 7, 8, 9 is 3 consecutive bull bars closing near their highs, but I thought the breakout was bar 8. Bar 7 is not really part of the breakout because it's not an impressive bar. You still thought the market was in a bear flag at that point, and then you get bar 8 and 9, and you think, oh, that changes everything. So, to me, the measured move might be more based off bar 8 and 9 than off bar 7, 8. Sorry, than bar 7, 8, and 9 because bar 7 was supposed to be still part of a bear flag, and then we got a surprise 8 and 9. So the breakout really was bars 8 and 9 instead of bars 7, 8, and 9. You can see that is around where the measured move up went to. 10, a doji bar, so not really all that great. One of the things about buying above 8 or 9 is we're going to get back to at least the bar 1 low, since the bulls who bought below bar 1 and were willing to scale in lower are probably going to make money. You can see we got a failed breakout below the neckline of the double bottom, so we might try to break out above the high of the double top now, which would be yesterday's bar 49 high. It's reasonable to think we're going to try and at least get some sort of breakout above yesterday's high. So bar 10, a doji bar, but still a bull bar. So we have 4 consecutive bull closes. Good for the bulls. We're definitely going higher, but the question is how much higher? And do we need to pull back first? It's reasonable to be long, betting we've seen the low of the day. It did end up being the low of the day. It just did not end up being a bull trend day. But reasonable to be long, betting we've seen the low of the day, but I'm not sure how much higher we're going to go without pulling back. 11, another bull bar, but a tail on the top. You can see, I believe we tested the high of the day, but we're not quite able to break above it. It's still bullish, and we're still going higher, but 8 and 9, a lot of really big, enthusiastic bars, and then 10, 11, smaller bars, 10, doji bar, 11, tail on the top. So yes, still bullish. Yes, we're still going higher, but it's not as crazy bullish as it could be. So the breakout is slowly weakening. It's possible that 10 was the spike, 10 was the pullback. So spike, pullback, and now we're in the channel phase, and that's what ended up happening. Every single, thing in the market, every single bar could be classified into either the spike phase, the pullback, the spike, the channel, or the trading range. The market cycle is spike, channel, trading range, and every single bar in the stock market on every single chart can be classified into one of those ranges. 12, a bear bar. We initially got a failed breakout above the high of the day. I don't know if we got above. Yeah, so we initially broke out to the upside of the trading range and we found sellers and disappointment. So a tail on the top and the bottom of bar 11. We're getting near the Globex high at this point. And what some traders will do is, this is the point I wanted to make. Usually most days don't break out of the low and the high of Globex. So some traders might sell the market as we're getting within a point or two of the Globex high and just take a chance that we don't break out of the high and that we form a high of the day before we get up here. It's a low probability trade, but the risk reward is reasonably good. And when you have really good risk reward, you're probably also going to have low probability. So the traders doing this, they know they're going to lose. No one's expecting to make money. They'll be very surprised if they do make money, but it's a reasonable thing to do to sell up in this area and just take a chance we don't break out above the high. It's more of a thing that an algorithm would do. It's not something that many individual traders would do because the probability is really low. But there are algorithms out there that don't care how many trades in a row they lose. They're computers. But for people, it's a bit of a tougher thing to do because you're going to lose so much. It's just going to feel like you're giving away money whenever you're doing it. So 12, bears want a higher high double top with bar 2, maybe some sort of wedge with yesterday, 1, 2, 3, something like that. I think less likely that you're going to get that, and this seems like more of a minor reversal. This is a really tight channel up, so I think it's going to get some sort of second leg, even if we do pull back. And 12 is not a particularly strong bar, so I don't think we're going to go. If we go below it, I don't think we're going to go that much lower. 13, an inside bar. It's a high one for the bulls. It's good for the bulls. We're probably going at least a little bit higher. Another bull bar closing near its high. At this point, 12 was a pullback. If you buy above 13, your options for a stop, you could probably just put a stop below 12 and just hope the market rallies and you can make whatever 10, 20 points, however much you're trying to make. Or you can probably put a stop below 9, or you could probably put a stop below the low of the day. Stop below 9 is probably a little bit skunky. You're probably going to have to move it, but it's not the worst place for initial stop. But the two stops that make the most sense are probably below 12 or below 6. 14 consecutive bull bars, reasonably good for the bulls, but there's big tail here, so it's really not as good as it could be. We are breaking out and getting consecutive closes above yesterday's high, so good for the bulls. We're probably going at least a little bit higher, but again, 14 is not closing all that strong. It looks like this is the channel phase in a spiking channel. Reversal down 15. Good for the bears to get this. I think that the bears who sell above 15 and are willing to scale in higher are going to make money. So where's their stop? Maybe a point or two past a measured move. So if you sell below 15, you shouldn't sell below 15. If anything, you want to sell above 15 and put a stop up here, and probably scale in maybe more at the halfway point of those two things. So if your stop's up here, you sell more up here, and then you make a scalp. You don't want to sell below 15. It's a bull micro channel. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars without trading below another bar. And the channel up from bar 8 to bar 15 is really tight. So there's probably going to be buyers below 15 scaling in lower. I don't think you have to exit longs below 15. It's a good looking bear reversal bar, and it's not usually wrong to exit below a good looking bear reversal bar if you're long. However, I think that the context here is reasonably strong for the bulls, so you do not have to get out. Buyers below and a big reversal up on 16. A good bull bar closing reasonably near its high. Do you buy above 16? You probably can. That we're probably going to trade above 15 because the bears who sold below 15, just basically hoping that the next bar looked like 23, it was a very low probability thing to do. So we're probably trading above 15 and are going to run those stops. If you're going to sell below 15, it probably makes more sense to do it with a really wide stop and scale in above 15. But, in that scenario, it probably just makes more sense to sell directly above 15 rather than selling below it. So 17, an inside bar. It's a high one for the bulls. Do you buy above 17? I personally would not take this high one. I think it's developing, still a tight bull channel. We're probably still going higher, but we did just trade below a bar. So the micro channel is no longer in effect. It's not quite as good as it could be because of that fact. It's also a bear bar. So I would probably not buy above 17. 18, a bull bar, but a tail on the top. So, what are we about to try and do? Well, the bulls want us to channel up like this all day. 19 changes everything because it's breaking out above the bull channel line. You can see its body, it's hard. It's easier to show it like this for this particular example, but you can see how this is a climactic bar breaking out above the bull channel line. So if you're really good at trading, some traders will exit on the close of bar 19, and that's part of what's causing 20. Other traders, I want to talk about, I guess I'll just go bar by bar for a second, but 19 consecutive bull bars, but breaking out above the bull channel. 20, a bear bar closing near its low. Okay for bulls to exit below 20. And then 21, bears would say micro double top, 19, 21. Bulls just hoping it's going to be a pullback. We're going to get two legs sideways to down and then resume the rally. The bulls know that once we get 21, that the rally is pretty much over. Well, first off, once we get 19, the rally is probably over. Once you get 20, the rally is very likely over, and we're going to start to go sideways. Usually what you do in this scenario is look for the market to pull back for, 10, 15 bars, and then look for a second leg sideways to up from the bull channel to the upside. Remember, the move from 6 to 21 is a breakout on a higher time frame, so it might get a second leg. So it's reasonable to look for the market to go sideways, breakout, sideways, rally. So it's reasonable to look for something like that in this scenario. The problem is how strong this was. So you got this move down, which made it a little less likely we were going to do that. But obviously, bar 23 is not a very predictable bar. So over here, some bulls, they see the close of 19, they think it's climactic, and they exit, and that causes bar 20. When bulls see 20, a lot of them will put a stop below 20 to exit below 20. It's totally fine to do that. Some traders might look to sell below 20 for a few legs sideways to down, since we have potential wedge 1, 2, 3, and we're overbought. So some bulls will put a stop one tick below 20, and now on the close of bar 20, their risk is about 1 point. So other traders, they see this and they see the risk is 1 point. They know we're probably getting back to the bar 19 close because it was a reasonably good bull bar. It doesn't mean we're going a lot higher, but we're probably getting back to the close. And if they bought the close of 20, they can try to make 4 points rallying to the bar 19 close while risking 1 point. So that is a reasonable thing to do. And you have probably, 35 to 40%, probably a 40% chance of making money. So I think that you can definitely take that sort of trade. Other bulls, some bulls algorithms will just do that for a scalp. Other bulls who are already long will add to their position on the close of 20. But everyone thinks that the rally is probably over from bar 20 because we're going to go sideways to down now. So when we rally back up to the bar 19 close, bulls who bought for a scalp and the bulls who were long for any reason and had to stop below bar 20 to exit think, well, now I have a better chance to get out. I can just get out above 20, a bear bar closing reasonably near its low. The bears who sell above bar 20 are going to make money. Additionally, you can just get out, at the bar 19 close. That makes sense as well, getting out around the high close. So the bulls think, well, I can save myself 4 or 5 points here. If I just exit up here, I know the rally's probably over anyways. And it's it's more likely that I'm going to end up taking, a loss below 20 or below 20 if I continue to hold this position. So bulls are selling for a lot of reasons, and that's what's causing 21. 21, a bull bar, but really small. It's more of a doji bar and a huge tail. So it's a micro double top, lower high micro double top, I suppose, with 19 and 21. 22, a bear bar, but a tail on the top, a tail on the bottom. 21 is not a very strong sell. So we might go more sideways here. And then you get bar 23. Bar 23 changes the whole day. It's a huge bear surprise. So now we have big up we have big down bars 2, 3, and 4. And then we have big up 7 through 19. And then we have big down again on 23. So to me, this is now more of a trading range. And we have big up, big down. I'm expecting confusion at this point and for the market to go sideways. So it's not really all that great to sell the close of 23 unless you have a really, really, really wide stop. Even a stop above the high of the day doesn't make that much sense because there's probably more sellers there than buyers. So I would not sell the close of 23 unless you're willing to scale in a lot. A lot of times when you get this sort of bar, you have to think about in trading ranges, what is the support and resistance? You say it all, Al says it all the time. The buy climax lows and the sell climax highs. The bar 42 high was resistance during 47. The bar 26 low is basically where we found support on 43. And you can see we ended up selling off near the bar 23 high instead of the bar 23 low. So it might be more of a buy the close bar than a sell the close bar. What are the odds selling 23 that you're going to get a measured move like this before we rally up here? Not all that great. So I don't really think it's a very good idea to sell the close of 23. It's better to wait and see if we have follow through, and then you can sell really, really, really small. But 23, as big and bearish as it looks, the reality is it's just big bar, big risk, bottom of a trading range. So to me, I think I'm in scalping mode now. I'm looking to sell high and buy low for scalps, maybe 5, probably 10 points. I think 10 points makes more sense on this day, but it's probably not unreasonable to scalp for 5 points. You'll notice the bars were a little bit smaller today, so the range ended up being a little bit smaller than what we've been getting. It's a little bit more normal, 49, 50 point day versus the 150 point days we've been having recently. 24, a reversal up. The bulls, it's a higher low double bottom. They're hoping that 23 is just a bear trap and that we're going to rally straight up, but we're not going straight up after this. The reality is if you sold the close of 23 and you use a really wide stop and you scale in, you're going to make money. We're going to come back to the bar 23 close at some point today, but it's just not an easy trade to manage. Or maybe not necessarily today, probably today, but maybe not necessarily. But the bar 23 close is going to be a magnet over the next couple of days for sure. An inside bar, a high 1, bar 25. Do you buy above 25? I probably would not. I realize that, bulls would argue 24 is the bear trap and it's a breakout pullback, and now we're going to start a rally, but I think it's probably better to just leave it alone. You can see it traded back towards the bar 23 close, and then traders bought at the market. Traders who sold here and didn't want to scale in, they were hoping we're going to collapse, get disappointed in 24, and they'll buy back their shorts with a small loss. Other traders, they said, yep, we're going to come back to this area, and they scaled in, and they weren't even let out 43. Traders still took a small loss getting out 43, but you can see finally on bar 53, traders were let out. Initially, sellers above 25 during 26. It's more of a doji bar. It's really nothing is all that good. Bulls want high one follow through, but I don't know if this is going to go all that far. Bears, they're hoping that we're going to get we had a low one on 25, and they're hoping that we're going to collapse below 26, but bottom of the trading range, bull bar, probably buyers below. Outside up bar 27, but a tail on the top, big tail on the bottom, and it doesn't close on its high. It's not able to break out of anything. So potentially, the neckline of some sort of micro double top, maybe the 24 high and the 26 high, and you can see 27 is not able to close above that breakout point, the 24 and 26 high. So probably still not as good as it could be. And then 28, a bull bar closing near its high. Some of this is bears buying back shorts, relatively disappointed. Bulls willing to buy, knowing that if we do go lower, we're going to test back up to the 24 high or that general area. Now, why is that? Because 23 is a spike, and we got a pullback 24, and so we're probably going to end up getting a channel if we do go further down. So if we get a spike pullback channel, it's going to turn into a trading range, and we'll probably test the high of the channel, the 24 high, if we do get that trading range. 28, a bull bar closing near its high, big tail on the bottom. Reasonable to be long, reasonable to buy, but it's not all that good. We're probably always in long at this point. The flips today, we probably went always in short on 3, always in long on 8. I guess always in short briefly on 23, but no one's selling that without scaling in, and then probably back to always in long, probably back to always in short. I don't think we went always in long quite in here. So maybe we finished today always in short, but 78 might have made it always in long. So it really got murky in here. It wasn't all that clear. 29, a big bull bar closing near its high. Where are we going? Probably the sell climax high, somewhere up in this area, maybe the 22 low. But the reality is, as strong as this looks, we just had this. So it's not like we're going to we're going to rally strongly above the high of the day and get a really big breakout. At least it's not worth betting on, us doing that. If we do that, you can just wait for later and when you have better follow through and just take one of those trades, buying much higher. So this is not a great area to buy. You probably can, but it's probably more of a scalp. 30, more follow through for the bulls, but a big tail on the top, and we're headed into a resistance area. So for me, I'm not really all that interested in buying up here. 31, a reversal down. Bears would argue that it might be some sort of low too. It's a big bull micro channel from 24 to 31, so it's not all that great to sell below 31. It is a double top with the bar 23, big sell climax, so a lower high double top. You can see we broke below the neckline of that lower high double top on 53 and ended up bouncing. So yeah, you can probably sell for a couple legs sideways to down. The context is reasonable, but it's not a very good bar, and we just had a buy climax. About 30% of the time, when you get some sort of double top, the second leg up will end up being a buy climax, and vice versa for the other side. 30% of the time, you get some sort of reversal down. Reversal up. The second leg down will be a sell climax. 32, a bear bar, but a big tail on the bottom. We're probably not going straight down. Why not? Because of how strong the rally up from 24 to 30 was. An inside bar, basically a high one on 33, but no one's really willing to buy above it. Low one short, no one really wants to sell below it. Where do I think we're going from here? I'm not all that sure. We're probably going to drift it sideways to down for a couple of legs, but at this point, I see a triangle. At this point in the day, it looked like it was forming like this. Like I said, it's important to be very careful when you're trading triangles because the apex can change and it can morph into a larger triangle like it did today. So it's important not to be fooled and to be really quick if you're going to short and be really quick if you're going to buy. 35, an inside bar, a bull bar. So a high one for the bulls, you could argue, but really not all that good. A high one after this, it's a high one high in a trading range, probably sellers not too far above. We initially found sellers above during 36 and big tail on the top, tail on the bottom. 37, any bull who bought above 35, scaled in 36, uses 37 to exit their longs. Might have to get a lower high from the sell-off down to 34, but might have to get a higher low from the rally overall up to 30. All right, 38, a bull bar closing near its high. Do you buy above 38? I probably would not. It's a high 2 for the bulls, but you're buying high in a trading range, and we might be coming to the apex of the triangle where the odds are not all that great for anything. It's relatively neutral, so I'd rather just wait and see what happens. 39, a bear bar, but a tail on the top and a tail on the bottom. Not worth selling. Bulls are hoping it's some sort of breakout pullback, and 3 pushes down, 1, pullback, 2, pullback, 3. Bears are hoping that this was the breakout. 38 The tail on it was the breakout, and this is a breakout pullback. And if you're sitting here thinking neither one of those arguments is really all that good, you're right. It's because this is not a good area for bulls to be trading or bears to be trading. It's really not a good area for traders. It's an expanding triangle. It's really just algorithms scalping on limit orders. Better to wait. Sellers above 39 during 40. You can see the tail on the top, but nothing to do here. 41, another bear bar, but probably buyers not too far below 40. So big tail. And then a surprise bar 42, bear bar closing near its low. This could be the breakout. So if you sell below 42, what are you thinking? You're thinking, okay, this could be the breakout. I want to see a bar that looks like bar 3. I want to see a really big follow through bar. And then you get 43. And you can see 43, what it actually is it's more of a higher low. So 6, 24, 43, it ends up being more of a higher low. And you're thinking to yourself, well, that's not what I wanted to see. It's really important not to just hope that we continue to go down. You can see the bears who sold the close of 23. What were they thinking here, right? When they got back to their entry price or around their entry price, were they thinking, okay, great, now it's going to go. I was right. It's okay that it pulled back this much. I still think my premise is valid. Or did they think, wow, I'm pretty lucky to be getting out around break even here and buy back their shorts? Looks like they did the latter. So again, could be a different type of triangle forming here. And we now have another higher low. The bears who sold were disappointed in 43, and that's what's causing the tail on 44. So as we fell a little bit during 44, some bears bought back shorts. Other bears thought, yeah, it's disappointing to see this doji bar. And instead of buying back shorts immediately, they took a chance that we get a big bear bar like on 44. Sometimes you'll get a bar that looks like, I don't know, like 2 or 3 or something on 44. And you never trade above 43. So you just collapse straight down. And 43 becomes a pause bar instead of a higher low. And instead, we got a bull bar closing relatively near its high on 44. So the bulls or the bears who stayed in their short, they have 2 options. They can exit above bar 44, or they can use the tail sell off on 45 to buy back their shorts. So traders 42 disappointed. Some bought back shorts, some waited and then got a bull bar. Then they bought back shorts, and that's causing 45. 46, the remainder of the bears giving up, a bull bar closing near its high, still around the apex of a triangle. I mean, you can buy 46, but you just have to know what you're doing. It did not close strong enough for me. Had it closed on its high and not gotten the micro gap down or pick gap, I probably would not have, or I probably would have bought it and then given it a minute or two and seen if it rallied. You can see here it's not all that good for the bulls. What they really want to see is 47 be another bar that looks like 46, and instead they get this disappointment bar. So it looked like we might become bullish here, but it ends up being a vacuum test of the high of the bar 42 high, the sell climax high. So really not all that good. The bulls who bought, they see this, they're not going to wait around. The risk you run by not exiting in here is something like this happening. So it's really not all that great. A lot of traders just looking to exit, and they sell their longs, and that causes 48. However, 4 straight bull bars, bulls are going to buy a 50% pullback. There's going to be algorithms willing to step in down here and take a chance that we get back up to this area. So some algorithms are selling and traders are selling, and the rest of them are buying, betting that down here we're going to end up finding support from this rally up and get a test towards the high. And so 49, a bull bar closing relatively near its high, yeah, but not that good. This is an area where bulls sold last time. So you think the bulls who bought more are probably going to end up selling in here. It's not a very good high one for the bulls. It's also a 3-bar tight trading range. So again, I would just rather wait. You're buying right on a bear channel line that's been pretty consistent all day. It's clearly paying attention to it. So if you're buying here, you're buying in an area where we continue to sell off. Really not all that ideal. 50, a bear bar, buyers below 49 initially. Outside down. So again, really not all that good. Triggers I guess you could say it's a low one short below 49, but it's really not that great. 51, a bear bar. We're paying attention to the moving average. We do keep selling off around the moving average, but again, tail on the bottom, smaller tail on the top, but still tail. This just looks like the middle of a trading range to me. I'm just not willing to do anything until we get a breakout at this point in the day. So middle of the trading range, we're in that general area. 52, a big bear bar closing near its low. You're selling off, which is good for the bears, but we keep finding buyers in this area and we keep getting higher lows. So you're taking a chance we don't get the higher low, which was true. We didn't, but you're selling in the lower third of the trading range. You can take it and take a chance that we get a big breakout. But then when you get 53, it's kind of similar to 46, 47, similar situation, 52, 53. So if you sold below 52 and you get 53, it's really not what you wanted to see. And so those traders are probably going to buy back shorts. It might be some sort of wedge. But really, the important thing to realize is that this is a disappointing bar. This is not a good follow through bar. You wanted a huge bear bar closing near its low, basically showing traders that that we're getting a breakout to the downside. Instead, you get this as follow through. So some traders are buying back shorts, causing 54. Other traders wait uh, and maybe exit above 54, or they use the second leg down on 56 to buy back their shorts around the bar 53 close. There's not really a lot of good reasons to be trading in here. If you are trading in here, you have to ask yourself, are you trading because you're down on the day, or are you trading because you think there's a good setup? So if you're trying to revenge trade and make your money back, it's inevitably going to go poorly. So 55, a bull bar, but a tail, 54, 55, probably buyers below 55. Another big thing to think about is just, if you have 3 trades this week, you can only take 3 trades. Is one of these going to be that trade, right? Is, selling below 52 and holding that kind of trade where it's the best trade is buying above 54, selling below 58, 59. Are these trades where you'll look back at the end of the week and you'll think, well, that was probably one of the best trades this week? They're really not. So it's really important to not get too caught up in doing that, and you'll get too caught up in the moment and miss the bigger picture, which is there's going to be more trades tomorrow. It's totally fine if there's not a breakout today. 57, a bull bar, possibly a second leg up. So the bulls, they think this is the bottom of the trading range, and they realize we might pull back, but they're okay with that and want to buy a reversal up and lower. Bears are hoping it's a 2-legged pullback, and their bear trend started on 52. But this is not a there's no conviction in this bear trend, so I'm not really interested in taking any sort of shorts here. 58, a low 2 short, but the pullbacks are pretty good-looking bull bars, and this does not look like a bear trend to me. Outside down 59, sell climax. And you can see we tested back up. It's a relatively big reversal down because of how big the tail is. And you can see we tested back up just above it on 66 before we sold off. So probably buyers not too far below. It's mostly a big doji bar in an area of support. 60, buyers below, reversal up 61. And then we basically got a couple of doji bars and started to go sideways. And you can see we tried to get a breakout of the triangle on 66, but there's just nothing. It's not that good. It doesn't close above the bar 59 high. It's not breaking out of anything really. It's following a 3 straight doji bars. So if you see 66 and you want to buy, you have to ask yourself, do you see a huge rally about to happen because of this? Or do you think this is probably just a little bit more of a climax, a quote unquote climax, and we're at the top of the trading range? So probably sellers in this area, 2 legs sideways to down. You can see, we basically reached the apex and we tried to break out to the downside. I think 72, 73. Those were reasonable shorts at the moving average, but really not all that great. Bears were selling the moving average a lot in the back half of the day, but nothing was all that awesome. And then 78, huge breakout, but bad follow through, just trading range, price action. So tomorrow it'll be important to see, again, if we get a gap up or a gap down, and if you get some sort of failed breakout or trap. Reasonable trades on the day, you can sell the close 2, 3, and then you can see start to reverse up from below the neckline. You can buy the close of 8, 9, surprise. Probably can buy 13. I would not buy anything after that. It's getting high in the range. I would probably not find a way to get short here. Had we traded below 21 or below 20, you could have theoretically sold for a wedge for a couple legs sideways to down, but it's probably going to be a minor reversal. This is pretty rare. You could buy above 28, but I don't know. I didn't think these were that great. These weren't the best trades of the day. You could probably sell below 31, lower high double top, but smaller ball towards the top of the trading range. I believe it's in the upper third. Yeah, so smaller bar in the upper third is probably fine, but again, not ideal. I think this is, the opening range was a little better than the rest of the day today. And then you could sell 42 if you're quick. You could buy 46 if you're quick. You could sell 52 if you're quick, but really probably better to do nothing for the remainder of the day. On the daily chart, it's a bear bar. So I still think we're getting back into this area. It's bad follow through for the bulls who bought above here, but we do have a pretty clear micro channel. Excuse me, 1 second. We do have a pretty clear micro channel to the upside, so I don't really think it's worth doing that much here on the daily chart. We'll see if we get into this gap before we pull back. I think we will, but probably buyers below tomorrow if we get there. So if we get a big gap down, maybe look for a reversal up, and if we get a big gap up, look for a reversal down. It'd be interesting if we gapped up tomorrow into this gap and then got a reversal down from this area. The weekly chart. We're triggering above last week's high, so good for the bulls. Generally, when you trigger a higher time frame magnet, you end up getting a pullback. So that's one of the reasons why you can see last week's high was here. Friday high, and we triggered above, and then ended up getting a deep pullback. A lot of the reason for that would be the weekly chart. So you can see we triggered it. The bulls, they hope it's some sort of higher low with this, and we're going to start to rally. But these three bear bars and the big gap down is way too damaging. I don't think there's much of a chance that we're going to end up getting a huge bear or a huge bull trend out of this. This is a trading range. So this is going to get a second leg sideways down. Does it start immediately, or do we rally a little bit first? I don't know. We might rally a little bit, but I think that ultimately we're going to form a lower high here and then get down to 5,000. And not really worth talking about the monthly chart right now. So, all right, that's the day.